The UST depegging, it is by far the biggest story in crypto right now, unfortunately. And as you can see by the chart here, the price of TerraUSD, whose ticker is UST, dipped all the way into the 10-cent range. And keep in mind, this is supposed to stay pegged as an asset to $1. So UST broke its peg. And while we're hoping for more details about the specifics in the coming days, it's led us to an important question. Namely, which stablecoin based on its architecture is the most resistant to this kind of catastrophic depegging? In other words, what is the safest stablecoin out there with which you can park your hard-earned money? If you need to put some of your assets into stablecoins, then stay tuned to this video, guys. We're gonna be breaking down the safest bets that are out there in the crypto stablecoin space. Welcome to the channel. I am Maddie and this is Altcoin Buzz. We are a crypto investment research company. We have documented many 100x returns on coins and tokens that are top projects today, really before anyone else was even talking about them. And if you want to see our detailed process for researching such projects, then our new and improved Altcoin Buzz access group is for you. Our plans start at $99 monthly. Be sure to click the link below for more information. Just keep in mind that crypto, as we've seen lately, does have a lot of corresponding risk when you choose to invest. Unfortunately, some of this risk even extends into the stablecoin space these days. So just bear in mind that this should not be considered official financial or investment advice. With that being said, let's take a look at some of the stablecoins out there and see just how safe they really are. First and foremost, take a moment and listen to this.
I think that the biggest risk, the thing that could go really massively awry with stablecoins that could be terrible for the crypto world overall, is if there's an algorithmic stablecoin that has no backing, that just has a sort of algorithmic mechanism that's meant to keep it stable, which we tried really hard to figure out one that would work in it.
Stable relative to?
You know, whatever their oracles are pinging the price of. It could be the dollar or the euro or gold or what have you. But there's a category called algorithmic stablecoins. I would put Terra and Celo in this category. There are a number of others. Basis was like this and they never launched. The thing that could happen is one of those could launch and be marketed very effectively and be significantly adopted. It could even happen in a market where people really, really need a stable currency and don't have one, and that's why it gets massively adopted. People who are not crypto speculators, people who just want to preserve their savings. If that protocol then blows up economically and falls apart, and the price of that goes, down half or close to zero, regulatory backlash. Imagine if we were sitting here today talking about how great our stablecoins were, where it had already been the case that like $1 billion stablecoin had collapsed and lots of innocent people had lost their money. It would be a very different situation. And that really could happen. There are economic experiments being run with some stablecoins that I believe personally could go that direction. And so I think the worst thing that could happen is if one of those gets really big before it fails.
Yeah. This is a video from May 2020 when Nevin Freeman, the co-founder of Reserve Protocol, warned us about algorithmic stablecoins with a lot of specificity, i.e. coins like UST. And unfortunately, it seems his prophecy was correct. But what exactly caused this entire mess? Well, if you're unfamiliar with the finer details, first of all, UST is an algorithmic stablecoin on the Terra Luna network. And the algorithm manages the peg by minting or by burning $1 of Luna for UST or vice versa. And so a huge sale of UST occurred in the marketplace. This reduced the price to under $1 temporarily, or so we thought. But what's supposed to happen next is the first UST sells $1 of Luna to mint $1 of UST, as we just described. Then if something else happens, the Luna Foundation Guard has a reserve of both Bitcoin and Avalanche that they can sell to redeem $1 value in UST. But what really happened is that the death spiral started as the value of all four assets, so UST, Luna, BTC, and AVAX, all fell simultaneously together in value, but obviously especially Luna. So in that situation, the algorithm says, hey, mint Luna when you burn UST. So as we showed you earlier, supply skyrocketed while price tanked. Needless to say, it's gone poorly for all parties involved. Luna's currently trading, as you can see, at a fraction of a penny. It may be up over yesterday's value in terms of 24-hour price movement, but just take a look at these circulating and total supplies. Suddenly, Luna tokens have gone from the range of billions to, as you can see here, yes, that's trillions. Total supply is 6.9 trillion. And as we saw, according to CoinGecko, the listing price of UST, although it currently sits just below 16 cents US, did dip below 10 or so cents. Again, keep in mind, this is supposed to be pegged pretty much unflinchingly to $1 US. And Terra is trying to accelerate the burn mint mechanism through Prop 1164, and there will be a collateralization measure that the community votes on, making UST a hybrid of algo and crypto collateralized. But needless to say, UST has done poorly. Of course, it is the reason that we're talking about this subject today in the first place, after all. And this massive UST depegging has once again put stablecoins in a pretty tough spot because investors are frantically moving their funds from USDT to BUSD or maybe some other coin. But it's probably a good idea to calm down and not panic. Take a breath. Watch this video, take some notes. There are some very safe options out there. How exactly do stablecoins peg to the US dollar in the first place? Well, let's review the types of stablecoins and exactly how they accomplish their task. The most common methods are number 1, fiat collateral, number 2, commodity collateral, number 3, crypto collateral, and number 4, algorithmic mechanisms. By far the most common type of stablecoin is backed by fiat money, i.e. fiat collateral. So this means that if the issuer is running their coin honestly, 100% of their funds are in cash, or what investors like to call cash equivalents, like money market funds and instruments with total liquidity really at any time. We'll get into this in a couple of minutes, but the largest stablecoins right now are fiat backed. And by backing their coins one-to-one with fiat, they maintain their peg with the US dollar. But here are some of the problems. These are issues with this type of backing. 2 factors specifically play into this. Number 1, there is a central issuer. So fiat-backed coins are by definition centralized, as someone needs to issue the coin and someone needs to track that the collateral backing is at one-to-one. Second factor is that we must trust what they say and report about that one-to-one backing. We must trust that it is true. USDT Tether in particular has an ongoing issue with this because many believe that they do not have the collateral to back their coins and that they are in fact running a fractional system like legacy banking does, the fractional reserve banking system. Then there's also commodity collateral. So the least common actually of the 4 ways to back a stablecoin is commodity backed. And the most popular of these coins is the PAX-G gold-backed crypto issued by Paxos, owners, by the way, of the ItBit exchange in the US. You can see here that PAX-G actually sits at number 92 in terms of projects with a market cap of just under $600 million. Its peg is not the USD, but the price of gold, in fact. And Paxos is a very important player in stablecoins as they are an issuer of 3 stablecoins, actually, 2 of which are in the top 9. And like their fiat-backed alternatives, commodity-backed stablecoins maintain the one-to-one ratio with a long-term store of value or hard commodity, like gold or silver. And the big advantage here over fiat is that while gold and silver markets can be manipulated too, they're less likely to be and are manipulated for shorter periods of time than fiat currencies. So they could theoretically maintain their value with relatively more stability over time. But problems do exist. First of all, there has to be an issuer and a way to account for the amount of commodity held to maintain that one-to-one ratio relationship between the stablecoin and the commodity. Second problem is that although some can and do provide proof of reserves, again, lots of trust is required here for these coins to work. And finally, third problem is they are not popular enough or liquid enough for the common uses of payments or in trading pairs on exchanges. Another form of stablecoin is the crypto collateral backed coin. And this just means that the stablecoins are backed directly by crypto. So because we have a crypto backed by a crypto to price in dollars, you may have guessed that the way to collateralize with crypto is to over collateralize. So this means that instead of a 1-to-1 ratio like with fiat backing, we may see a 1.3-to-1 or a 1.5-to-1 ratio. And here are the problems with that. We have 2 big problems, in fact, with crypto-backed coins. Number 1, there's the added risk of crypto backing crypto. So if there's a macro failure, then everything unfortunately retraces in the same direction. Second problem, all crypto-backed coins are not capital efficient because, as we just mentioned, over-collateralization is necessary for a crypto-backed coin. So a coin could have $100, for example, worth of ETH, on deposit, but only issue $60 worth of stablecoin. There are better ways for us and the system to use our capital. And finally, we have algorithmic stablecoins. These use an algorithm to manage their pegs. So it was an algorithmic stablecoin in the case of UST that really started all earlier this week. The algorithm manages the peg in a smart contract, usually by having a mint and burn mechanism. For example, Neutrino's USDN has this mechanism with the Waves token, and Tron's USDD has a similar mechanism with Tron. The Tron stablecoin just launched, and they're already trying to back it with a reserve. USDD already has depegged once, however. And so unfortunately, this is already a little bit concerning. And yes, there are some problems with this model of stablecoin. Number one, the lack of collateral. And number two, that ever-present risk of the so-called death spiral. That's where we have a vicious cycle of many people all at once really wanting to redeem their stablecoin for the other coin, pushing the value of both down significantly. Many want to get out of their UST position, so burning it creates more Luna, and now Luna is flooding the market and its value is declining at the same time, as you can see. The circulating supply by burning UST for Luna has skyrocketed, as we pointed out before. Again, we're going to have a deep dive into what's really happening with Luna and UST in a few more days once the smoke starts to clear and when we start seeing things stabilize a little more. What is going on with stablecoins right now? Well, the crisis is ongoing, and those of us who invest in crypto understand the risks when we buy a coin, really whether it's a blue chip, a small gem, or a favorite game or NFT project. But we expect and want less risk when we hold funds in stablecoins, of course. The effect of some stablecoins losing their peg to the USD and the losing value is devastating really to the whole industry. Now, crypto was already trending in a downward direction, but really UST losing its peg earlier in the week on Monday only exacerbated the catastrophe. Once again, we'll have more on this soon, but it does look like it was a coordinated attack. And since then, Tether briefly lost its peg on Thursday morning, Asia time as well. As of right now, it's back to 99 cents, which is almost back to being right on peg. But certainly that was a concerning observation. Taking a look here at some of the biggest stablecoins on CoinGecko.com, ranked by 24-hour volume, we're going to take a look at a couple in particular. Specifically number 4, DAI, and number 7, Frax. But before we do that, just keep in mind that really every stablecoin has depegged at one time or another. And actually, as you can see from this chart from CryptoBank, every coin has gone below 99 cents at one time at least. And some of these have gone as low as 57 cents for USDT. We saw in a previous video that happened several years ago, and even 89 cents for USDC. And by the way, they've also depegged on the upside, above $1. 4 of the top 5 actually have had a price of $1.15 or higher at one time or another. So sometimes this just happens due to market sentiment. About 60% of the total stablecoin volume on any given day is just USDT and USDC. But they're reacting differently now based on the current market conditions. In fact, there's been some long-running stories like this one from all the way back in 2018. Some say it's FUD, fear, uncertainty, and doubt that Tether does not have the collateral and actually runs a fractional system. And that's very much contributing to the overall lack of trust in this environment and probably why Tether depegged earlier this week. As we said earlier, all fiat-backed coins have a central issuer, so why are they all reacting differently? Why were USDC and BUSD, for example, trading at $1.02 while USDT depegged? USDT does not do regular audits, although many industry government entities have requested them to do so. This helps continue the lack of collateral story. But the other two, USDC and BUSD, are both US regulated. So their issuers are Circle for USDC and the aforementioned Paxos for BUSD that Binance uses as its stablecoin on the Binance exchange. Circle and Paxos follow US regulations with regular court filings and audits showing their proof of reserves. And although they're a centralized issuer, they are seeing rewards from this compliance with increased trust from the crypto investing public that the assets are actually there. So right now we have USDT, which is more or less right on peg, USDC, which is also sitting at exactly $1, and BUSD, which is pretty much right on peg as well. Things seem to have stabilized, but it's been a volatile week. Let's talk about DAI. This is the hybrid stablecoin. DAI is a mix of crypto backing and algorithmic backing. DAI actually started as an algorithmic-only stablecoin where deposits into the Maker Vault would create new DAI in a decentralized way, but then it went the crypto-backed route. DAI, which is really what used to be called multi-collateral DAI, is 80% backed by USDC at 38%, ETH at 24%, wrapped BTC at 10%, and USDP, which is another Paxos stablecoin called the Pax Dollar. That's at 7.9%. And then the remaining 20% is from very small added sources, which means that DAI has the added benefits and drawbacks of two pegging mechanisms. As far as the drawbacks, well, first, it's no longer decentralized as it's dependent on USDC and ETH for 72% of its collateral backing. And second, it's way over collateralized at 164%. The benefits, though, are that first, it should be more stabilized than algorithmic-only coins and can avoid the so-called death spiral just by selling off collateral. Secondly, backing with crypto carries less risk when there's an algorithm and smart contract involved in the coin management. Especially one of each of algorithmic and crypto-backed benefits help to negate some of the other weaknesses to keep DAI strong. And while DAI is the weakest of the top 5 in terms of adoption, it's holding up pretty well and currently trading right on peg at $1. So DAI is okay in an otherwise pretty messy market. Here's one that you may not have heard of, Frax. It's possibly offering a new hybrid stablecoin model that could be the future. It calls itself the first fractional algorithmic stablecoin. And that is because it's partly backed by the algo and partly by collateral, specifically USDC. So today Frax is 88% backed by collateral and about 28% backed by algorithm. They use their own coin, Frax shares, ticker FXS, to help manage the mint burn mechanism of the algorithm. And along with part USDC, FXS becomes the second coin that you get when you redeem your Frax. How much you get is based on the collateral ratio at the time of redemption, and that can vary. It's actually a pretty smart setup, and the coin, as you can see, has a market cap of nearly $1.5 billion. And Frax is also the fourth stablecoin, along with UST, USDC, and USDT, that is part of the Curve 4 pool that really started this whole chain of events, but more on that in a future video. And by trying to use the best collateral and the best of the algo features, they're holding up well in the current market. In fact, they spiked as high as $1.05 early on Thursday. Right now, they are basically at $1 for all intents and purposes. So Frax is doing okay. It's certainly maintaining its peg. We hope that this breakdown helps to explain some of what's happening, some of the craziness that's ongoing right now in the marketplace. If you're looking for a great marketplace to trade into or out of stablecoins for that matter, then our top choice is MEXC, because with MEXC exchange, you have more trading pairs, and nearly every country in the world, including the US, by the way, can use their services. Check out the link in our description below. You still can avail yourself of an offer, 25 USDT. That's an airdrop for signing up with a new account, and you're also going to get 1 month access to Altcoin Buzz access, a $99 value. So by signing up using the link below, you're getting $124 in value for free. Check it out. If you're still watching this video, be sure to like, subscribe, share, and hit the bell to receive notifications. Never financial advice, but of course, best of luck if you do choose to invest. Stay safe out there, members of the Altcoin Buzz army. Check out this video here, this video here. Take care. And as always, we do hope to see you again soon in our next video.